Hello and welcome. In this video, we will learn about penny stocks. Alright? Penny stocks are one of the most tempting and dangerous areas of the stock market because these stocks trade at a very low price and they are typically associated with small, lesser known companies. Okay. Now, in America or in the United States, they define a penny stock as the one that trades for less than $5 per share. Okay. This is their definition. But in India, we do not have an official definition. The term penny stock generally refers to any stock trading at a very low price, often under 10 rupees or 20 rupees per share. Okay. Now, you must remember that the low price only doesn't define a penny stock. Okay. Beyond the low price, penny stocks almost always share these features. First is the small market capitalization. The company's total value would be generally lower than 500 crore rupees. Okay, they are small, often struggling or unproven businesses. Okay, next is high volatility. The price of the stocks can swing wildly. Meaning, for example, a stock which is at 2 rupees can jump to 3 rupees, which is a 50% increase, correct? Or fall to 1 rupees, which is 50% decrease on very little news or volume. So, high volatility will be or can be observed in penny stocks. Next, lack of information. These companies are not covered by major analysts or financial news. It is often very difficult to find reliable financial data or learn what the company actually does. Okay. And finally, low liquidity. Very few shares are traded daily, meaning it is hard to sell your position or shares. But sometimes high liquidity also can be observed in penny stocks. We will cover liquidity in a different video, and there I will show you the high liquidity of penny stocks. Okay, so low liquidity cannot be taken as is. All right. Now the question is, why do people buy penny stocks? Why do people buy them? This is due to their lottery ticket mentality. Okay. Let me give you an example. Let us say that a share of company X is being traded at 1 rupee. Okay. Meaning, if you want to buy one share of company X, you will have to pay 1 rupee. Now, what people feel is that if they invest 1000 rupees, then they would get 1000 shares. Correct? 1 rupee per share, so 1000 rupees, 1000 shares. And they feel that if the share price increases to 10 rupees from 1 rupee, then they would get 10,000 rupees. They invested 1,000 rupees, they are getting 10,000 rupees back. So it is like winning a lottery ticket, correct? For this small investment, they are getting this much amount back, right? So this is why they buy the penny stocks. 1,000 rupees is a small amount, correct? At this price, if you try to buy shares of normal companies, then you can buy either 2 or 3 or 4 shares, right? In 1,000 rupees, you can get 4 shares if the share price is around 200, 250. But here, you are getting 1,000 shares for 1,000 rupees. So this is why people fall for the trap. Okay? People feel that this will become a multi-bagger. Alright? But the unfortunate thing is that for every multi-bagger, there are thousands of investors who would have lost their entire investment. Okay? Now, what are the risks of penny stocks? The risks of penny stocks are the liquidity trap, no real business, high risk of delisting, and the famous pump and dump scheme. I'll explain this in detail. Okay. First is the liquidity trap. This is the most direct risk. You might be able to buy a penny stock or some penny stocks, but when it is time to sell, especially if the price is falling, you will find that there are no buyers. Okay? You want to sell, but there are no buyers. What do? You feel trapped, correct? In India, this leads to the dreaded lower circuit trap. We have learnt about upper circuit and lower circuit, correct? So you will see your stocks hitting lower circuit if you buy penny stocks. Okay? The stock will hit its lower circuit day after day, and you can only watch as your investment evaporates, because you will not be able to sell the shares. All right. Next is, many of these companies, meaning penny stock companies, are shell companies, meaning they do not have real business, no products, no revenue, etc. They may exist only on papers. Okay? Their financials are often fraudulent, meaning they cook up the financials, or they may be non-existent also. Next is that the company can easily go bankrupt if it exists, or fail to meet the minimum requirements of the stock exchanges. Okay? When this happens, the stocks will be delisted, meaning they will be removed from the exchange. Okay? Now, if this happens, then you will not be able to sell the shares at all. See, when you buy the penny stocks, then everything will be fine, let us assume. But after buying the penny stocks, if the stocks get delisted, meaning if the company gets delisted from the exchanges, then how will you be able to sell them? they are not available on the exchanges at all. Correct? So all the shares that you had bought would be worthless. All right. Next is the pump and dump scheme. Let us learn about this in detail because this happens a lot of time. The steps in pump and dump scheme are these. Okay. First is accumulation. Before the pump and dump scheme begins, the manipulators, or we call them as operators, quietly buy a large number of shares in the target company. Operators are people, okay? They quietly buy a large number of shares, tens of thousands of shares in their target company. They do this slowly and carefully over weeks or months to avoid causing any price movement that might alert others. Okay. What is their goal? Their goal is to build a massive position at a rock bottom price. Okay. That is what happens in the accumulation step. Next is the pump step. This is where they create hype. Okay. This is the most visible part of the scam. The operators launch an aggressive marketing campaign to create a buying frenzy and then artificially drive up demand. And to do this, they use various channels. Okay, they use various channels to spread false or misleading information. For example, they will use social media. This is the most common method today. They create dedicated Telegram groups or WhatsApp groups promising insider tips or guaranteed 10x, 20x returns. They send out mass emails, SMS blasts, or post on online forums claiming that the company has a secret patent or a huge new contract, etc. Okay. The operators will trade shares back and forth among themselves during this stage or step to create the illusion of high trading volume. So, due to all these steps, the poor retail investors fall into the trap. Okay. So, retail investors fall for this trap because they see these tips and they see the price movement to buy the penny stocks. Okay. We have something called as FOMO, fear of missing out. This is when people feel that if they do not buy now, then they will repent later. Okay. And this is the real frenzy step. Thousands of people pile in buying the shares. And when this happens, the price of these stocks, for example, may move from 1 to 5, 5 to 10, 10 to 20, so on. Okay. So when thousands of people have bought the shares, the fourth step happens, the dump, or we call it as the betrayal. Once the share price has been pumped to its target, which will be generally 100% or 1000% or higher, the operators who had bought in at rock bottom prices begin to sell, or they start to dump their entire shares. Okay, because they are selling thousands or tens of thousands of shares, the market is instantly flooded. There will be far more sellers than buyers. And the buying frenzy created by the hype will not be able to absorb this massive sell off. And so the price collapses. The dump triggers a catastrophic price crash, often in a matter of minutes. Okay, so what happens is the price plummets, it falls massively. Okay, and when it falls massively, it hits the lower circuit. We have learnt about upper circuit and lower circuit, right? So day after day, the stock prices hit lower circuit. So all the retailers who bought during the pump at 5 rupees, 10 rupees or 20 rupees are now trapped because they cannot sell their shares. Why? Because there are no buyers. Okay, so the operators walk away with massive profits, while the victims, meaning retail traders, are left with worthless shares. Okay, so this entire scheme is highly illegal, and it is actively prosecuted by regulatory bodies like SEBI. So be careful when someone says that this will give you 100x returns, or these shares will give you 1000x returns. All right. Now the thing is, while it is technically possible for a small unknown company to grow into a massive corporation, which we call it as a multi-bagger, finding it is the difficult part. Finding it would be like finding a needle in the haystack. Okay, it requires deep investigation, deep knowledge, and a lot of research. All right. For 99% of retail investors, buying penny stocks is not investing, it is pure gambling. All right. So you better not fall into the trap. Okay. So this is about penny stocks.